Welcome to the Achievable FINRA podcast. I'm Tyler, the founder of Achievable, and we have affordable courses for the FINRA SIE, Series 6, Series 7, 63, 65, and 66 exams with industry best pass rates. Each Achievable course includes everything you need to pass the first time. A full textbook, videos on key topics, thousands of questions backed by our memory-enhancing algorithm, and full-length practice exams. You can try it out for free at achievable.me. And if you like it, use the code podcast to get you 10% off at checkout. This podcast was made from a video by Achievable's FINRA course author, Brandon Rith. If you'd like to have the visual aid of a video, please go to Achievable's YouTube channel and search for the video by the same name.
Let's break down this short call option quote. Short, 1 ABC, Jan 50 call at 4. One of the most important aspects of options is the language involved with them. So let's make sure that this option quote is crystal clear by the end of this video. First, the word short, which can actually relate to a few different things. Short typically refers to a lack of ownership, or more simply, selling this option. When an investor sells an option, they are selling a contract that will obligate them to potentially do something in the future. And that's the key. When an option is sold, it always comes with an obligation. We will discuss more about that obligation later in this video. Investors sell options in specific numbers, and each contract covers 100 shares of stock. So this option is going to involve 100 shares of ABC stock. Now, ABC is a made-up fictional company. In the real world, there are options on many publicly traded companies like Netflix, Morgan Stanley, Caterpillar, and this option could easily be a Netflix option, and if it was, it would cover 100 shares of Netflix stock. Most option questions will involve a fictitious company like ABC or XYZ, mostly to keep the question general in nature. Each option will also have an expiration month, and options typically expire on the third Friday of the expiration month at 11:59 p.m. Eastern. So we can safely assume the end of this option or the expiration of this option will happen on the third Friday of January at 11:59 p.m. Expiration is important because it relates to something that options have called time value. This is a call option which provides a right to buy 100 shares of stock at the strike price, and $50 is the strike price. For as long as this option is in existence, the option buyer will have the right to buy 100 shares of ABC stock at $50 per share. But wait, remember, we're not talking about the option buyer here, we're talking about the option seller. The option seller must fulfill the right of the option buyer should they exercise the option. If the option buyer has the right to buy 100 shares of stock at 50, that must mean the seller has the obligation to sell 100 shares of stock at 50 if the exercise occurs. The value of an option is always in comparison to the market price of the underlying stock. If the option provides a better transaction price than the market, then the option has something that we call intrinsic value. While an option buyer hopes that their option gains intrinsic value, the option seller does not. In fact, intrinsic value usually means more losses for an option seller. Let's bring this to an extreme to make sure that we understand why intrinsic value is bad for the option seller. Let's assume that this option was sold, and shortly after, the market price of ABC stock rises to $90 per share. The option now has $40 of intrinsic value, which is great for the option buyer, but terrible for the option seller. There's no question that the option will soon be exercised, so let's assume that it is. And when the exercise occurs, that's when the seller must fulfill their obligation. Again, their obligation is to sell 100 shares of stock at 50. If the option seller doesn't already have 100 shares of ABC stock in their possession, then they'll have to go to the market, buy those 100 shares at $90 per share, and turn around and immediately sell those shares to the option buyer for $50. Buying shares at $90 per share and selling them at $50, that's a $40 per share loss, or a $4,000 overall loss given that there are 100 shares involved. The higher the market price goes, the worse the situation is for someone that sells a call. Best case scenario, the option never gains intrinsic value, and that would occur if the market price stays below 50. At $45 per share, the option buyer would have no incentive to exercise the option and buy stock at 50 when they could just go to the market and buy it for 45. At that point, the option has no intrinsic value and therefore would expire eventually if the market price just stayed there. And that's what the option seller hopes for, that the option eventually expires worthless. When this occurs, the option seller received a premium for selling the option and then didn't have to do anything. The premium refers to the last part of this quote, which is the $4 at the end. $4 is the premium, which is what the investor receives when they sell the option, but it's a little deceiving. Remember, options are on a per share basis, so a $4 per share premium really results in a $400 payment to the person that sells this option. The seller is paid the premium to compensate them for the obligation and, generally speaking, the risk they take on by selling this option. And of course, the buyer is paying the premium to gain their right. That's the game of options. It's two different investors betting on where stock prices may go in the future. The premium can be further broken down into two components that we've already discussed: intrinsic value and time value. Let's assume that the market price of ABC stock is 51 when we find this option quote. At 51, the option has $1 of intrinsic value. To find an option's intrinsic value, you really only need two things: the market price of the underlying stock, being ABC stock in this example, and the strike price of the option. If the option provides a better transaction price than the market, then the option has intrinsic value. And there's actually a pretty easy way of remembering this, and that's call up, put down. Now, this is a call, so let's focus on call up. When the market price of ABC rises above the strike price, call up, the option has intrinsic value. If the market price goes down below 50, it doesn't have intrinsic value, as we talked about before. So one last time, at a market price of 51, this option has $1 of intrinsic value. Call up again. The remaining part of this premium represents time value. If the premium is $4 and the intrinsic value is $1, that must mean that the time value is $3. Breaking down the option this way really helps an investor understand what they're being compensated for when they sell an option. $1 per share, or $100 overall, given they cover 100 shares, is compensating the investor for the intrinsic value that they're currently exposed to. $3 per share, or $300 overall, is compensating the investor for time, knowing that more time involved means there's more opportunity for the market price to go up and more risk for the person that sells this option. If this option were to have a longer expiration, it would have a higher premium just because of the fact that it has more time value. So for example, let's compare this to a February 50 call. The January and the February 50 call both obligate the investor to sell stock at 50, but the February 50 call is more risky given that it involves that obligation for 1 month longer than the January call. More risk will result in a higher payment made to the investor. In this example, let's say that the February 50 call has a premium of 6. Still assuming a market price of 51, this option also will have $1 of intrinsic value, similar to the January 50 call. However, the February call has $5 of time value, which is $2 more of time value than the January option. Bottom line, the longer the option, the more risk it exposes to the person that sells the option, and therefore the more that they'll ask to be compensated when they sell that option. And just so you know, premiums fluctuate up and down every single day, just like stock prices, and they're driven primarily by supply and demand. Investors that sell riskier options will want to be compensated more for the additional risk they take on. Okay, we're getting to the end here, so let's go ahead and summarize everything that we've talked about. This is a short option, which means it was sold by an investor, and by selling that option, that put them into an obligation. Short calls result in an obligation to sell 100 shares of stock per contract at the strike price. So this option will obligate the investor to sell 100 shares of ABC stock at 50 should they get exercised. The $50 strike price stays fixed regardless of the direction of ABC's market price. The option expires on the third Friday of January at 11:59 p.m. Eastern. And the premium reflects the value of the option, or what the seller will be paid, on a per share basis. And that's $4 here. A $4 premium will result in a $400 payment, given that every option covers 100 shares of stock. And of course, the premium is compensating the investor for the risk they're taking on and the obligation that they're putting themselves into.